All right, three, two, one. Good morning. My name is Jonathan Levin. I'm a columnist for Bloomberg Opinion. Here with two of my friends and colleagues, Karl Smith and Allison Schrager, great economists and columnists here for Bloomberg Opinion. We're here to talk about the CPI report that's going to come out in about 5 minutes, and I'll give you a real quick rundown of what the expectation is. The street consensus thinks that the month on month seasonally adjusted number is going to come out at 0.6%. That's driven by the uptick that we've seen in energy prices. But importantly, the core is expected to come out at 0.2%. That could potentially be quite significant, I think, for the Federal Reserve because it would be the third straight zero point 0.2 on a seasonally adjusted basis. So, if you do something like a 3 month seasonally adjusted annual rate, you're starting to get really, really close to what the Fed would consider target. And there are lots and lots of caveats to consider there. A lot of people think that three is a trend is a silly rule of thumb, but nevertheless, it's looking a lot better than it was some months ago. Having said that, guys, let me just ask you, like, how far have we come? How optimistic are you at this juncture? Allison, can I put you on the spot here?
Well, I don't think there's any denying we've come really far from a year ago. I remember doing this with you and would just be like, it's coming down, and then it would just go up and up and up. So it's definitely we're in a better place now. Um, and I mean, 3 months, it's not a trend, but it's not a trend either. So it's definitely would be good news and suggest inflation for now is stabilizing. I think what concerns me is, you know, people talk about inflation expectations being anchored, they have the whole time. But I think another thing worth looking at is expectations, sort of um, confidence around these expectations. And what you're seeing still is a lot of inflation uncertainty and variance around expectations month to month, which we certainly didn't have pre-pandemic. And that suggests that markets could still get spooked a bit if we get a bad report or we get any sort of shock. So I'm optimistic about this report, but I'm still cautious.
Okay. What about you, Carl? Like, how would you put the inflation story in the broader economic context at this point? Your probability of a soft landing and so forth.
Yeah, so I think that obviously, if soft landing is looking better and better, I mean, the kind of economy that you would need for that, one where the job market is slowing but not slowing too fast, where demand is finally, being chipped away at, but we don't think is going to fall off a cliff. That kind of stuff, I think, is coming together, and so. The Fed has a chance for a soft landing. One thing that's funny to me as an economist is that people like got obsessed with these month-over-month numbers, and like we've always that is even sort of outside of my I guess tuning because we always do year over year, right? And so like we're looking for what I think if we're looking for the trend, I would be like when core hits 4%, that would be I would start to feel like the Fed thought that that was like a solid trend. Not that they'll go up until then, but like if you say what would you need to feel super confident about the fact that the economy was going in the right direction, and that wouldn't happen to the end of the year. So I think that in terms of how long we would need to be a trend, it's probably significantly longer than this. But of course, the street is sensitive to what happens, minute to minute, month to month on that. But the economy overall, I think, is headed probably about as well as we could want it right now. I think
Okay.
that's my
And
sense.
I guess 45 seconds to go here, so I may cut you off, but uh, what do you make of this the weird cognitive dissonance that we're all getting from the fact that the economy seems to be accelerating, but inflation is still coming down? What does that mean?
Well, we did live with like 20 years of that, so I mean, it's not
True,
shocking.
true,
We had some booms and they couldn't get inflation above two. So I mean, who knows?
right.
Yeah, and I think in a broad context, I don't know if it's full on accelerating. I mean, I think that like we're probably gonna have like a little boost in GDP, but that's Some of that is timing. When we look at the longer term stuff like the job market, it seems to be kind of slowly getting just slightly weaker, slightly weaker. I think that's probably uh, the trend that we should expect here. Yeah.
Yeah, let me just cut you off real quick. So, the news here is probably going to be the fact that you get a 0.3% a month on month on the core. So that's little bit hotter than expectation. Again, the expectation had been for 0.2%. You end up with zero point 0.3. The month on month headline. Right on expectation, 0.6% month on month. And when you work all of this out on a year-on-year basis, core still ends up being 4.3%, which was what the street's estimate was, and headline ends up being 3.7% versus 3.6% in the survey. All that being said, you do get a little bit of a knee-jerk reaction. I see
Mhm.
I'm looking at the 2-year yield tick up. This is not a catastrophic move as far as these things have gone on CPI days lately, but it's still early going here. I'm going to say 2-year ticked up like 3 basis points on the move, and it's still kind of on the move as humans start to take over from the algos and actually look at what's at what's going on here. But so we didn't get three as a trend. We got two as a trend and a little tiny bit of an uptick. Like, does this put us off course, or are we still basically in the same waiting game we were in five minutes ago, as far as Fed policy and so forth? What do you think, Carl?
Well, so I don't know that right off this changes things that much. I think people who were super optimistic, that like I said, that we'd already established a trend, and that the Fed was going to feel completely comfortable from here on out. Probably have to revise that. But I just didn't think that we were quite to that point anyway. So my expectation hasn't changed. I was looking. I noticed you said that we might should look for something to happen in education. Maybe an upside surprise there. I'm not sure if we see that. It looks a little cool to me. Yeah, that's what I'm looking at right now.
Yeah, I'm still waiting for some parts of my screen to populate so I can dig into the core numbers here. But let me let me throw let me throw one screen up here for everybody to look at. Whoops, that screen share seems to be taking just a moment to load there. Huh. My oh, okay, there we go. Okay, so here are uh, here are some of the drivers. You know, I'm trying to figure out what's going on with this screen right now.
I think you can still see your August table over in the corner.
Yeah. Okay. Um, well, okay. So in any case, um, let's just back up for a sec here and uh, let's talk about the energy story for a second while I get my screens going here. So the energy story has been, of course, oil prices. One of the hardest things to forecast traditionally seen as volatile and not indicative of the trend in monetary policy world. And so even though we get this 0.6% headline, the expectation is that the Fed is going to sort of look through this situation. But of course, energy prices, pump prices are one of the biggest things when it comes to inflation expectations. So, you guys think that we potentially get um, some risk of upside down the road from the energy price, not shock, but mini shock that we're seeing over the past couple months here? What do you think, Allison? What's the risk from oil right here?
Well, I mean, it could just be, just sort of a blip month to month, but I mean, there's always, of course, always a risk, sort of uncertainty still with Russia and, you know, anything else in the world that, if energy prices do stay high, it will spill over into other forms of inflation and start really impacting people's expectations. I think everyone made fun of Larry Summers a couple weeks ago when he showed that picture of inflation came down and then it went right back up to the same. If we have a really long sustained high oil prices, I mean, that could happen again. I think that that's the risk. But, as you say, oil prices are unpredictable and tend to be pretty volatile. That is why anyone thinks it's ridiculous. The Fed does tend to look at core and not overall inflation, just because this isn't something they can control and something that does tend to be quite volatile. So, while it's hard on consumers, I think there's reason not to be too worried about it just yet.
Yeah,
Okay.
so I think that oil prices make a big deal and gas prices make a big deal for like consumer surveys of, inflation expectations, but they don't do much for like market-based inflation expectations. And so, that's the kind of thing that the Fed is concerned about short term. Over the long term, if we were looking at like price increases that lasted for years and years and years, that would be more of an issue. Like the period, I guess, in the early 2000s, or maybe mid 2000s, right before they developed fracking, it was going up year after year after year after year. That was something the Fed had to look at. But I mean, even this spike back from 2021, I don't think the Fed took the oil price spike itself to be that big a deal, and that's probably going to be a lot bigger than anything that we see right now. That's my guess.
Okay. All right. I did want to bring everybody back to the data here as I finally got this worked out. So here again is the core month-on-month contributions chart, and so what you can see, no big surprise here. Core goods in the blue. Actually giving us some continued deflation. It's really all a core services story at this point, and you dig into to core services and what's actually driving it. It looks like the big one this month. I don't know if you can see the line item here, but transportation services within the core services, right? So you get a contribution of 0.15 percentage point from that transportation services. Uh, that's that that's doing a lot of work there, and within that, I think that the so one of the big drivers
Hmm.
here, motor vehicle insurance, right? So I'm just sort of speculating a little bit here, thinking out loud, but um, this could kind of be like the long tail of some of the weird behavior that we've seen in auto prices, right?
Yeah.
It's still long used car shock, that crazy used car shock that started back in 2021. We're still experiencing the reverberations of it. So maybe this is a moment to pump the brakes a little bit and say, gee, uh, you know, core missed by zero point 0.1 percentage point. People were looking for a zero point 0.2. We got a zero point 0.3 in part because of motor vehicle insurance.
Hmm.
Um, maybe that's not telling us much about overall inflation pressures in this economy. You guys think that that's fair reasoning, first
I mean, that
blush
that
here?
makes sense to me off the cuff. I mean, I would assume that's from revaluations, right? Like higher revaluations. I don't know what the insurance sort of like valuation pace on that, and if this is a very sensitive month, so I don't have a good read on that. But I mean, in the absence of a broader story, I mean that's just what I'm going to assume. You had huge used car price valuations going up. That's going to be a year later or so, when people get charged more on their insurance than they would otherwise expect, right? So that's not super surprising. Um, so we didn't know exactly when that was going to come into the data. Uh,
Yeah. Another thing that's worth underscoring, of course, is shelter, right? Because shelter is one of these inertial things, fairly easy to model, we think. Uh, and the expectation is that what we've seen in the cooling in market prices, really going back over the past year, we're going to start see filtering into the actual CPI, PCE numbers. And here you have the seasonally adjusted month-on-month shelter number, the contribution really starting to tick down in a
mhm.
meaningful way. And because this is so inertial, and because it's sort of baked in, you would hope that we'll see some continuity in that. So that may continue to be, um, I guess, a headwind or a tailwind when it comes to
Mhm.
inflation, but it'll continue to be a positive driver. The story that we want to see, we're going to continue seeing from shelter, and really some very encouraging numbers out of this month's month on month. So on balance, that's potentially a positive thing. Um, what is you guys' view on housing and this economy at this complicated juncture where home prices are basically stable, but nobody can get into a home because mortgages are inaccessible, prices are still historically high relative to incomes. What is the way out of this housing conundrum that we're in right now?
Well, I think who has the upper hand here are are builders, right? I mean, so they're the ones who can put new inventory on the market. They don't have to deal with the selling an existing home for a loss. And we have seen existing construction inventory, or existing construction inventory keep going higher and higher and higher. Deliveries haven't been as fast as we like to see, but there is a lot of stuff in the pipeline. There's a lot of rental stuff in the pipeline, and so I think that both is the way I would expect us to get out from an economic standpoint, and what we seem to be seeing, although we're not seeing it as fast as I would like to see it. What I worry about there are sort of regional pressures, right? So I think maybe Miami, the Texas Triangle, those areas are going to do really well in terms of putting up new housing and having the shelter component come down. It's here, like in the Northeast, where that's just going to be a little bit more stuck. I mean, you just can't deliver as much new inventory up here, and so as we've seen, sort of the effects of the sort of work from anywhere thing, basically completely vanished now. I think you're just going to see the Northeast is probably going to be tight for a while, and there's not really a way to relieve that. But new supply should help us, in the rest of the country, and I think that's probably the best way out that we can see right now.
Okay. And any chance that housing uh, inventory is being tight as they are at the moment, that housing comes back as an inflationary concern, or do you think?
So not as an inflationary concern. I do think that existing housing prices could go up, but of course that doesn't figure into inflation. Inflation, it would be the rent on existing houses, but the actual prices, I think, my sentiment is that they probably will keep rising. I think the way that the both supply and demand are, under an enormous amount of strain, but it's really like existing housing supply that is locked down. It is people who have, the 2.5, 3% mortgage, and they just are not going to let it go. That are locked down, and then every year we get a new generation of people, who would normally come out of rental housing, who are going to go into, a single-family home, and of course, a lot of them are going to wait. A lot of them are going to be on the sidelines, but not all. And so even if you've cut that demand in half relative to how much you've locked down existing, it's a demand side I think that has the more pressure built in. The supply side is locked down, so I would expect us to see existing housing prices start to rise, not in a shooting up sort of way, but kind of in a tilting up month to month, a little bit higher, and probably until we get a break in rates. And then, ironically, you would think a fall in rates would help, housing prices, but you'll probably see a huge surge of locked up existing homeowners come back in, and that will be probably a wild time for existing prices. 'Cause I actually think that they will decline as interest rates go down, but we'll see.
Huh.
See, I'm not
Okay.
convinced that
Uh,
interest rates will we might have that dramatic. I mean,
Will go
mortgage
down.
rates, well, historically, mortgage rates aren't that high, and mortgage rates are largely based off the 10-year. So there's reason to believe that, that's going to be persistently high no matter what the Fed does. I mean, I think one of the reasons people are
Tell me
partially
that
waiting on
story.
what? Who told me that story?
Tell me that because see, I've got it. Yeah, about the 10 years. So I'm convinced that we're headed back to a similar world as we were before on the 10 before the pandemic. If you look at basically global savings, demographics, all that um, it's hard to tell a story about how the fundamentals are that much different than they were in 2019. Now, obviously, we have a period of high inflation where, around the world where central banks are coming in. But once that's gone, I've been thinking about this for a while. I really don't see a way to support interest rates above the 2% level, 1.5% level for super safe securities.
Well, I mean, said first of all, global capital flows are different. As well, like we have more uncertainty around like a big part of the 10-year is the term premium, which includes a big risk premium. And as I said, it's a riskier world in a lot of ways, particularly around inflation expectations. So that's another reason it would be higher. And as I said, we've just had more volatility, which also breaks into the term premium. And also, I mean, I hate to say it, but there's also, much higher debt loads that people well, the governments are all around the world, which also can feed into term premiums. So I think is it there's reason. Also, you know, there, there's also the spread between mortgages and the 10-year to also worry that that could also be
mhm.
persistently higher. So I mean, there are reasons to be structurally higher. I think one reason we might not get this dramatic, oh, let's go back to the market is I think a lot of people are waiting on the sidelines, like expecting, like I think they share your expectations that, oh, well, like in another year, it'll go back to normal and be back to those 3% mortgages, when the Fed was buying every mortgage-backed security they could. But I'm not sure that is coming back. And eventually people are just going to get used to higher mortgages. I mean, mortgages real historically aren't that high. And then they're just going to have to adjust their expectation. Maybe more people will start getting adjustable rate mortgages again. Maybe they'll start having to have bigger down payments. I mean, we'll see. But the housing market might just be different, but it will adapt.
But in that scenario, doesn't con, you know, you're assuming either home prices need to come down to adjust for a permanently higher mortgage rate environment, or people need to curb their consumption of something else, right? Because like we've had a certain expectation built in of what we would uh, pay for housing over the past decade, and uh, permanently higher mortgage rates uh, could be an enduring shock to the system, no?
Yeah, and I mean, it'd probably be a little bit of both. Like as Carl says, as more housing comes on the
Mm,
market, certainly in some regions that should lower prices some. And also we might change our expectations. Maybe you can I hate to say the smaller houses, maybe in less what people did in the past. I'm not saying it's good. It's not good news, but I mean, as I said, if prices are higher, people, might just change their behavior.
sure. So I did want to bring it back to the number real quick in our last 5 minutes here, because I think that our initial reaction here I don't know if I want to say was the right one, but the market seems to agree with us, right? So there was this kind of knee-jerk reaction when the number came out and core was a little hotter than expected. But not only has that knee-jerk, I have the 2 year up on the screen right now, the 2 year yield. Not only has that been completely undone, but yields are now moving slightly in the opposite direction, right? So
Mhm.
yields are lower than when the print came out, and my read on that. Uh, I don't know if you guys agree with me, but we had our speculation about the drivers. If it was like motor vehicle insurance, if on the final analysis that was like the big thing that caused the surprise. There are a lot of reasons why you maybe look through that. It wasn't that big of a miss. I believe the unrounded number was 0.27, right? So I mean, if some people
Right.
had modeled a 0.24 and it comes out at 0.27, it's like okay, there's a lot of noise in there. But the market is over this. What, what do you are you guys over it too? Do you share the market's opinion at this point?
So I think what you just said about housing coming over, in a really good way. Actually, this month being a little bit better, than expected. I mean, that's the bigger that long term story for core. If housing didn't do what it was supposed to do, then the Fed would have a big problem because everyone is counting on that to help us through, right? And so it is doing what it's supposed to be doing, maybe giving us a little bit better than that. And so to me, that makes you largely comfortable. I mean, like we do, you go to Supercore and then you say insurance was bad one month. You're kind of getting down to a really, really narrow basket of goods. And so for me, if the big dog is going in the direction he's supposed to go, then that means that things are kind of like on track, and that's what we see. Yeah.
Right,
hmm
right. What about you, Allison?
Well,
What do
I'm
you
with
what do you make of this whiplash in the market in the last 30 minutes?
I think this is just turning into like no one knows anything and trying to read tea leaves where there are none. I'm with Carl that we don't really know anything until I think at the end of the year when we sort of have seen something, there's less, seen what goes on in all seasons. So, I don't put too much stock in it.
All right, all right,
Mhm.
all right. Very well. Well, with that, that's your CPI number for August right there. Core comes out 0.3, had been expected to be 0.2%. The market initially sends yields a little bit higher, but quickly undoes it as folks seem to conclude that a a few basis points of miss on an estimate doesn't really matter as much as the long-term trajectory, as Karl and Allison have put it. And so, if you were looking for threes a trend in terms of three 0.2% prints, we didn't quite get that. You didn't get that perfect narrative, but it's not that far from that narrative either. So nothing to see here, nothing to get worked up about. That's it for us for this month. Thank you, Karl, and thank you, Allison, and thank you for being with us.